So for the best part of the last 3 years, well before COVID, for the best part of the last 3 years, not just giants like Maruti, but the entire auto AM space was running on spare capacity. Right, September, from what I've heard from several OEMs and ANCs, was a blowout month, 85% utilization, and every part of Gurgaon and Manesar was going full throttle. And it apparently looks like October will also be a full capacity utilization month. So when you get not just top line improving, but your entire capacity gets utilized, the bottom line improvements, and I think the bottom line improvement story will show up very sharply in the quarter ending December. Those can be non-linear, and I don't think the market and people like us have fully understood the extent of operating leverage and hence the extent of earnings ramp up that we could see if October, November, December continues to be recovery months for the economy.
Saurabh, I must share with the viewers also that I quite look forward to some of the notes what is coming from Marcellus over the weekend, and what really stayed with me over the last over the long weekend, a note which was specifically centered around technology, where Saurabh is making a case that we are investing into companies which are adopting technology in this new normal. Now, Saurabh, you've spoken about Asian Paints extensively. You've spoken about HDFC Bank extensively. The world knows, I know, you know that those are technology enablers. Anything else which fits the cut for you where a company is able to morph itself into a different orbit because of technology enabling?
I think let's look at two names that I think you guys highlighted in your commentary a few minutes back, and both of which are part of our portfolio. So let's look at HDFC Life, right? So life insurance in India, we all know how powerful LIC is and how big it is. What HDFC Life has done over the last 10 years is bring big data to bear on underwriting in a more comprehensive way than anybody else we've seen in India. Their customer questionnaires tend to ask more questions than other life insurers do. And I can personally verify, having been through their health checkup, their health checkup is more rigorous than that of many other life insurers. As a result, and having done this for 10 years, HDFC Life has collected more data on people like us and our mortality risk, and that's allowed them to do better underwriting, and hence their underwriting profits, the return on embedded value has ended up being superior. Now, with many other big data plays, this becomes a virtuous cycle. Once you collect more data than others and your business becomes more profitable and you reinvest more in big data and in the modern term data lakes, it becomes very hard for others to catch up with. So on the face of it, superficially, many of these private sector life insurers look similar. But to our mind, HDFC Life, this is a year of research, seems to have done way more tech and data analytics than anybody else. And I think we've discussed before, perhaps, Bajaj Finance in the context of the NBFC sector is very similar. Way more data analytics have been brought to bear over the last 7-8 years by Rajiv Jain and the BAF team. And that's allowed them to post an ROE, which pre-COVID was in the mid-20s, even after COVID is in the early 20s, in an industry where the other champions struggle to get beyond, say, 15-16% ROE. So tech, the use of world-class fintech in the best Indian firms, I think has become a defining feature of the last 10 years. And people like us, our clients, millions of Indians out there are benefiting from this.
If I spend another minute sort of trying to decode the model of Indian IT companies, the TCS and the Infosys of the world, they are IT services providers, but right now there's a rising tide towards whole digital adoption and they're benefiting out of it. Would you go with the consensus view that Indian IT companies have hit a pot of gold, or would you say that these are IT enablers and at best these are great ROE companies but not great growth companies?
I think I agree with you. I agree with you that they are enablers, but therein lies both their strength and their weakness. Because they're enablers, Nikunj, they'll be way less volatile than the US tech product companies. I think TCS probably is the most appropriate enabler. TCS is 2.5 lakh, 3 lakh people. I think 1.5 lakh people get retrained by TCS every year. TCS reorients its labor force with the changing needs of its Fortune 500 clientele. So whatever, when remote infrastructure management was the rage, TCS was trying to do that well, and it did a pretty good job. And application development was all the thing to do. 5, 6, 7 years ago, TCS was doing that. Now that we are going into the world of cloud and cloud-based big data, TCS has retrained itself and reoriented itself. I think amongst the Indian IT services firms, we find that this company's ability to retrain lakhs of people every year and give the Fortune 500 the exact enablement that they need at this point in time is an enormous competitive advantage. It's not easy to train lakhs of software engineers year after year and mold yourself to the changing needs of your client. That makes the Indian IT services model more robust than a typical US tech product-driven model. The product-driven model is volatile, right? When the product is selling well, it's great fun. But when the product goes out of fashion and technology moves on, product becomes obsolete, it's game over. TCS in that regard has shown that it's way more robust. I think it's 50 years, right? 50-year-old firm, 3 or 4 CEOs perhaps in 50 years, every single one internal recruit. The world's third largest IT services companies, and a great tribute to what our country can do by servicing the needs of the world rather than trying to say we'll do something blazingly new.
Okay. Saurabh, what are you making of the kind of commentary we've got from some of the mega financial companies just over the last couple of days pointing forward? It looks like, we're picking up steam. There doesn't seem to be any sign of a faltering, so to speak, at least for now. Are you also optimistic about where we stand with regards to the recovery?
So I think what seems likely to happen is the next 3-4 months, the commentary will stay pretty upbeat because for obvious reasons, as we've unlocked the economy, recoveries have improved, loan demand is coming back as verified by that remarkable HDFC Limited guidance earlier this week. So demand is coming back. We're also seeing, quite tangible data that in small towns, residential real estate activity is improving. So I think next 3 months, all the way through to say Jan, we will get good numbers, good guidance. I think the air pocket, to use Nikunj's phrase, is what happens as we approach the fag end of the fiscal, because that's when people like us will say, is there a demand pickup? Right. So at the moment, it's a COVID unlock pickup, right? Post unlock you pick up. But going into spring next year, people like us would be looking to see, is there a demand pickup that can give the BFSI names another leg up? Between now and I think Jan, I think it's relatively blue skies and smooth sailing because it's a relatively straightforward journey, right? Your recoveries are picking up, loan demand is coming through, liquidity is in abundance in the system. Even for second rung lenders, liquidity is available, and hence I think we've got 3-4 months of smooth sailing, and then we'll have to see Jan, Feb, March. Is there a deep, meaningful demand pickup which helps the lenders get their loan book growths back to say the 20% mark?
Okay, and from the second rung lenders, anything that you would be looking at, Saurabh?
So what I have to say is I have good news on this front. Normally, I don't have good news for the secondary rung lenders, but the data we are getting from our channel checks suggests that recoveries are coming through even for second rung lenders, not just the sort of HDFC Bank, Kotak Bank, Bajaj Finance standard Marcellus stuff, not just the standard Marcellus holdings, but even the second rung lenders are seeing recoveries pick up. Secondly, if you see in the CP market and in terms of bank finance available for NBFCs, liquidity has become, once again available for one notch down below the elite. Liquidity is available, and if I look at the last 6 months, cost of borrowing has dropped by 1.5%, even for the non-Premier League lenders. Just that our house style doesn't sort of, encourage us to invest in them. So we haven't invested in them. But I think the tailwind that we are here seeing in terms of recoveries picking up, financing available, post-COVID demand pickup should help even the second rung for the next 2-3 months or so.
Saurabh, almost 8.5% equity divested now in Reliance Retail. Still circumspect of investing in Reliance Industries, or has that view changed now?
No, so as we've discussed before, right, this company's ability to command respect in capital markets, both equity and debt markets, build vast projects, execute projects on time, finance those projects at the lowest possible finance cost of any Indian companies. I don't think on any of these fronts we have seen any other equal in our country in the last 20 years or so. As we discussed, I think in our preceding interaction, the quandary for us, the dilemma for us has been return on capital below cost of capital, and thus the concern on can we really generate wealth for our clientele on the back of this, right? So whether it's raising money at the most competitive rates for my entire lifetime, actually, if I look back at even my school days, raising money at the most competitive rates for my entire lifetime, executing large projects at world-class standards, rapid delivery. In fact, last night I was reading a book about the early refineries that Reliance built in the 80s. People like DuPont couldn't believe how quickly Reliance was building refineries in India in the 80s, the speed at which they were executing. And in 2020, we sit here marveling at the way they're building out 4G, 5G, and then the retail piece. So execution on the money, fundraising, unbelievable. Return on capital above cost of capital, we're just keeping an eye on that. And once that goes through, once return on capital exceeds cost of capital, we'll have a long, hard look at this.
Fair point. Any contra opportunities, Saurabh, in the markets that you're spotting right now? We're on the brink of earnings season. We're going to kickstart today with TCS. But TCS aside, where do you think can we really see those green shoots or yellow weeds emerge?
So I think on your channel in the last 6 months, I've kept highlighting, look at auto. I think the auto recovery, touch wood, so far has worked out nicely. Long may it continue. I've highlighted the pharma chemicals opportunity, and we're seeing immense demand. It's unbelievable as to how much demand there is in the intermediate chemicals, API, and in the entire ecosystem. We've discussed why the frontline great financial stocks were a raging buy for us through April, May, June, still are. I think the area which we're getting very intrigued about is, given that we are hearing that in small town India, residential real estate demand is picking up. We're seeing some positive price action as well. The cost of a home loan is now 7.5%. So the gap between home loan rates and rental yields have once again narrowed. Is it time to look at the building materials companies, right? Is it time to look at the building materials companies? Not Asian Paints, Pidilite, that those are long-standing Marcellus holdings. We have Astral Poly in some of our portfolios, but we're taking a broader look at the building materials space to see can they benefit if demand for building materials comes through, especially since so much data out there suggests that rural India is doing well. Can that entire tiles, plywood, sanitary ware, that entire ecosystem flourish again? So we're having a look at that space in light of the data coming through about small town India pickup and early signs of green shoots in the real estate market, not in Mumbai, unfortunately, but in other cities like Ahmedabad.
Saurabh, the agrarian economy still accounts for only 15% of the economy. Mm-hmm. If one works with an assumption that the agrarian economy is back and we are going to be in for a big expansion, that's still 15% of India's GDP.
Yeah, so Nikul, that's true, but in a way that doesn't do justice to the nature of the rural economy distinct from the agrarian economy. So if you look at, say, the FMCG giants, say the Daburs and Maricos and Nestle's, or you look at the auto giants, the Heros and Marutis, my reckoning is over the last 6-7 months, the bulk of their pickup, the majority of the demand pickup has come from what we call the rural economy, right, as opposed to the agrarian economy. So why is that? Why is it that rural India has become such a powerful demand driver for giants like Maruti, Hero, Dabur, Marico, Nestle? I think the reason for that is rural India seems to be way more than agriculture. There seems to be the bulk. I suspect the bulk of economic activity, and unfortunately because of COVID, haven't been able to do my trips in the countryside. But my suspicion is rural India, the majority of the rural economy is no longer around agriculture, and that's allowing them to get a fillip from Philip, from a rising demand for, say, service-oriented work in small-town India. One way to gauge this is the speed at which workers return from the countryside. So we are all expecting a reverse migration post Diwali as people come back to the cities, workers come back to the cities. But if we find that the rural economy is continuing to, or companies like Nestle, Marico, Maruti, Hero are continuing to post solid sales in rural India, then that would give you and me quite a bit of validation that rural demand is more than just agriculture. The other story I think we'll hear about through next spring is credit offtake, rural focused credit offtake from the leading lenders in the land. I strongly suspect they won't give us data on this, but our work suggests that because there is now enough big data available on lending into the countryside and both civil and smartphone data, I strongly suspect in the last 6 months there's been a big push by private sector lenders to distribute more credit in the countryside. Without that, the Maruti Hero type pickup wouldn't have worked out. So if there is more credit going there, regardless of agriculture, the sheer availability of credit will give rural India a good 2-3 year pickup.
Point that ultimately is the availability of low interest rates and credit which will make all a difference. Saurabh, we've extensively discussed Asian Paints, and speakers have really used all kind of superlatives to discuss Asian Paints and the kind of compounding machine it is. But I sometimes sometimes we don't pay focus on Pidilite. If one has to choose between Asian Paints and Pidilite, I know you own both, but if I put a gun to your head and say, Saurabh, pick one, which one would you pick and why?
So we have both in the portfolio, and we are happy shareholders on both. We made lots of money on both. Where Asian Paints edges out most other Indian companies, right? It's very difficult to build a company of this quality in our country. Where they edge out most other Indian companies is the ability to institutionalize processes, take it beyond family, take it beyond 1 or 2 superstar CEOs, and institutionalize processes across many generations. So this is, I think, the 3rd generation of Asian Paint promoters. In the last 40 years, they would have had 5-6 CEOs, all internally recruited, trained, groomed to world-class standard. And an Asian Paint CEO change is never a point of discussion on, say, TV channels. And yet the company keeps compounding at an epic rate. And I think that deserves a lot of respect in our country, where it's very difficult to institutionalize stuff, right? I'm running a small company in Marcellus. There's only 50 of us. I know how hard it is to institutionalize processes in our country. And this company, over 70 years, has institutionalized selling a complex product, 5,000 SKUs across 75,000 dealerships. Great CEOs come and go. They don't seek limelight. The market doesn't notice them. And this company continues compounding and generating immense wealth. 2,000x returns since 1982, without drama, without fuss, without dilution. A lot of respect. I think it's a privilege to live in and invest in a country and a company like Asian Paints and learn from them. Pidilite, under Bharat Puri and under the guidance of the Parekh family, has come leaps and bounds. Not just over the last 30 years, I think the last 6 years, Pidilite's made huge strides forward. My reckoning is, and if you read the annual report, you can see, my reckoning is they're building monopoly number 3. The first monopoly obviously was adhesives. The second one, at the turn of the century, they started building waterproofing. That too, they have now completely dominated. And now I think they're going into building their 3rd monopoly. It's in the annual report. They're allocating capital smartly. And I think this could become the first Indian family to dominate 3 sectors. 3 is very difficult. Most Indian families, the best they can do is dominate 2 sectors. Pidilite potentially could become the first Indian family to dominate 3 sectors.
All right, Saurabh, we'll leave it there. Thanks so much for joining us this morning.